Okay, so you want to own a prison. Maybe you've heard that the government pays private companies to lock people up. Maybe you've seen CoreCivic or GEO Group mentioned in a financial news piece, and you notice they're publicly traded. Maybe you've done the rough math. 2 million incarcerated Americans, government contracts worth billions, guaranteed revenue, no marketing budget needed, customers you didn't have to go find. Sounds like a defensible business. It is not a simple business. Here's what most people picture when they imagine owning a prison. The government sends you inmates, you house them, you cash the check. Like a self-storage facility, but the units come pre-filled by court order. The reality is something much stranger, much more fragile, and much more politically dependent than that. Because a private prison isn't really selling housing. It's selling a promise to a government that would rather not think about the problem. And the moment that government changes its mind, or its administration, the entire financial structure that looked so stable yesterday can collapse in a single memo. This is the story of how owning a prison actually works, what it costs to get in, where the money actually comes from, and why one of the most profitable periods in private prison history was followed, within months, by a 40% wipeout in market value. Not because crime went down, not because something blew up, because someone in Washington sent an email. Let's start with what you're actually buying. When people describe private prisons, they use the language of real estate. Beds, occupancy rates, per diem fees, capacity utilization, and for a long time, the two largest private prison operators in America, CoreCivic and GEO Group, were literally structured as real estate investment trusts, REITs, the same corporate classification used by shopping malls and apartment complexes. The prison building was the asset, the inmates were the tenants. But that framing misses what is actually for sale. A private prison isn't selling square footage. It's selling administrative relief. It's selling the government's ability to say, we don't run this place, they do. It's selling political distance between an elected official and the daily reality of incarceration. That distinction matters enormously, because it means your customer is not motivated by value or quality. Your customer is motivated by deniability and capacity. And that is a very different kind of customer than a tenant or a shopper. Keep that reframe in mind throughout everything that follows, because it explains almost every structural feature and almost every structural weakness of this business. So what does it cost to get in? Building a new prison is not like building a warehouse. The costs are, by any reasonable measure, extraordinary. According to industry estimates and state budget analyses, a new medium security prison costs between $100,000 and $150,000 per bed to construct. That is per bed. A modestly sized 1,000-bed facility, not a large prison by contemporary standards, runs between $100 million and $150 million before you've hired a single guard. A larger, 2,400-bed facility, which is roughly the size of CoreCivic's Family Detention Center in Dilley, Texas, comes in closer to $250 to $350 million in construction costs alone, depending on location, security level, and required infrastructure. Maximum security facilities cost significantly more, sometimes exceeding $200,000 per bed, given the reinforced construction requirements and specialized systems involved. That's the headline number. It is not the hard part. The alternative entry path, and the one that has historically driven much of this industry's growth, is not building from scratch. It's acquiring or leasing existing facilities from state governments, often at a discount, and then winning the management contract to run them. In 2012, Corrections Corporation of America, the company now known as CoreCivic, sent letters to prison officials in 48 states, offering to buy their facilities outright in exchange for a 20-year management contract and a guaranteed 90% occupancy rate. Some states agreed. Ohio sold CCA a 1,700-bed facility for $72.7 million in 2011, roughly $42,800 per bed, a fraction of new build costs. That sounds like a deal. It is, until you read the fine print, which we will get to. Before a single inmate walks through the door, a private prison operator faces a wall of pre-launch costs that don't appear in the acquisition headline. Licensure and accreditation alone can take 12 to 18 months and cost several $1 million. The American Correctional Association accreditation process, which most state contracts require, involves comprehensive facility audits, staff certifications, policy manual reviews, and ongoing compliance reporting. Failure to maintain accreditation can void your contract. Insurance for a correctional facility is a category unto itself. You need general liability, professional liability for healthcare services, employment practices liability, and specific coverage for the unique risks of operating a detention environment. Annual premiums for a mid-sized facility can run $2 to $4 million per year, and insurers have grown increasingly reluctant to cover this sector. After 2016, when major banks began pulling financing from private prison companies and insurers followed, some operators found their coverage options narrowing sharply. Staffing before opening is another hidden cost. You can't run a trial period. A prison needs to be fully staffed with trained corrections officers before it accepts a single person, because a half-staffed prison is a dangerous prison. Recruiting, hiring, and training a staff of 300 to 400 guards and administrative personnel before revenue begins costs anywhere from $3 to $6 million in payroll, benefits, and training alone. Legal fees, environmental reviews, zoning battles, and community opposition in the surrounding municipality can add another $1 to $3 million before ground is broken or a contract is signed. So by the time you're ready to open a 1,000-bed facility that cost $120 million to build, you've spent an additional $10 to $15 million in pre-revenue costs that no one mentioned in the pitch. Your actual cost basis is closer to $135 million. And you haven't housed anyone yet. Now let's talk about where the money comes from. The first and largest revenue stream is the per diem payment, the daily rate the government pays for each inmate held in your facility. This is the core of the business model. As of recent contract filings, federal per diem rates for immigration detention run roughly $95 to $130 per person per day, depending on security classification and facility type. State criminal justice contracts have historically run lower, often in the $50 to $70 per day range, though rates vary significantly by state and have generally increased over time. At $100 per day per person, a reasonable mid-range figure, a 1,000-bed facility running at 90% occupancy generates $32.9 million in annual per diem revenue. That sounds solid. Remember that number. The second revenue stream is auxiliary services, and this is where the economics get genuinely strange. Private prison operators don't just house inmates. They also contract out or subcontract virtually every service inside the facility. Food service, medical care, mental health programs, educational programming, vocational training. Some of these are legally required. Others are contractually negotiated add-ons. Healthcare contracts alone can generate $8 to $12 per inmate per day in additional billing. A 1,000-person facility earning $10 per person per day in medical and program service fees generates another $3.3 million per year on top of the per diem. The third revenue stream is commissary and telecommunications, and this one deserves a closer look because it functions more like a captive marketplace than a service. Inmates and their families pay for phone calls, video visits, email, food items, hygiene products, and other goods through third-party vendors who share revenue with the prison operator. A 15-minute phone call inside a private detention facility has cost up to $15. Hygiene items sold through commissary are frequently marked up 2 to 3 times their retail price. The Prison Policy Initiative has estimated that families of incarcerated people spend, on average, $13,000 per year supporting a loved one inside, a significant portion of which flows through these contracted service channels. For an operator with 1,000 inmates, commissary and telecom revenue sharing can generate $1 to $2 million per year in additional passive income. The fourth revenue stream is labor productivity contracts. Federal Prison Industries, known as Unicor, pays federal inmates a wage, often between 23 cents and $1.15 per hour, to manufacture products for government agencies. Private prison operators who participate in work programs can charge additional management fees or generate cost savings by using inmate labor for facility maintenance, laundry, food preparation, and grounds work. Critics call this exploitative. Operators call it rehabilitation programming. The financial impact is real either way. It reduces operational labor costs by several $1,000,000 annually in larger facilities. Added up, and a 1,000-bed facility at 90% occupancy generates approximately $37 to $39 million per year in total revenue across these four streams. Now let's look at what it costs to keep the lights on. Staff is the single largest expense, and it cannot be easily compressed without creating catastrophic problems. A 1,000-bed medium security facility typically employs 300 to 450 staff members, corrections officers, medical personnel, counselors, administrative staff, food service workers. At average private prison wages, which have historically run 20 to 30% below public sector equivalents, you're looking at roughly $18 to $22 million per year in salaries and benefits alone. One of the industry's most documented cost reduction strategies is understaffing, paying for fewer guards than contracts technically require, and falsifying staffing reports to conceal it. In 2016, CCA admitted to billing Idaho for approximately 4,800 hours of security posts that were actually left empty over a 7-month period. The facility was so dangerous that inmates called it the Gladiator School. This is not an edge case. It is the predictable result of a fixed revenue, fixed cost structure in which the only variable a manager can actually control is labor. Healthcare is the second major cost, and the one that surprises most new entrants. Annual inmate healthcare costs can exceed $10,000 per person per year for a general population, and significantly more for aging inmates or those with chronic conditions. For a 1,000-bed facility, healthcare runs $8 to $12 million annually. Operators try to contain this through managed care subcontracts and by limiting access to specialist care, which generates lawsuits, which cost money, which creates additional liability exposure. Utilities, maintenance, and facility upkeep run another $3 to $4 million per year. Insurance, $2 to $4 million. Administrative overhead and corporate fees, $1.5 to $2 million. Legal reserves for inmate litigation. Because lawsuits are not occasional, they are structural. Another $1 to $2 million. Total annual operating costs for a 1,000-bed facility, approximately $33 to $40 million. That means your operating margin before debt service on the $135 million you borrowed to build and open this place is somewhere between negative $1 million and positive $5 million. Before the mortgage payment, you're barely breaking even in a good year. After debt service, typically $8 to $12 million annually on a facility of this size, you are, in a normal year, losing money. This is why the per diem rate matters so much. A $5 swing in daily rate per inmate translates to $1.8 million per year on a 1,000-bed facility. The difference between profitability and structural loss is often a single contract renegotiation. And here's where it gets interesting. Because private prison operators solve this problem in a way that has no analog anywhere else in commercial real estate. They invented the bed guarantee. Here's the mechanism. When a private prison company signs a contract with a state or federal government, it doesn't just agree on a per diem rate. It negotiates a minimum occupancy clause, also called a bed guarantee or lockup quota. This clause states that the government must pay for a minimum percentage of beds, regardless of how many are actually occupied. According to a 2013 analysis of 62 private prison contracts by the advocacy group In the Public Interest, 65% of contracts included occupancy guarantees, and the most common requirement was 90%. Several states guaranteed more. Arizona locked in 100% occupancy at 3 facilities. Louisiana required 96%. Oklahoma, 98%. Read that again. The government doesn't just agree to pay for inmates it sends. It agrees to pay for beds that might be empty. If crime drops, if sentencing reforms pass, if the prison population falls, the government still writes the check for 90% of the facility. In effect, the private prison operator transferred population risk back to the taxpayer. The company locked in its revenue floor regardless of what happened to actual incarceration rates. This is the structural innovation that makes the business viable. And it is also the trapdoor, because a bed guarantee only helps you as long as the government honors the contract, and as long as the government that signed the contract is still in office, still aligned with your business model, still willing to defend the arrangement publicly. When the political wind shifts, you discover that your guaranteed revenue stream has a very large asterisk attached to it. On August 18, 2016, Deputy Attorney General Sally Yates issued a memo directing the Federal Bureau of Prisons to begin phasing out its use of private facilities. The memo was 2 pages. Its key finding was blunt. Private prisons simply do not provide the same level of correctional services, programs, and resources as federal facilities, and do not save substantially on costs. CCA, which had built its entire business case on the federal relationship, with 51% of total revenue coming from government contracts, and which had marketed itself to Wall Street as a stable, government-backed cash flow story, watched its stock price fall $9.65 per share on a single trading day. That was a 39% decline in one session. By October, the market cap had fallen by more than 40% from its pre-memo levels. A securities class action lawsuit was filed shortly after, alleging that CCA had made materially false and misleading statements about the quality and compliance of its federal facilities. The company eventually settled that case for $56 million. It also changed its name from Corrections Corporation of America to CoreCivic, in an acknowledgement that the CCA brand had become a liability. The company didn't change its contracts. It didn't change its facilities. The business was identical on August 17th and August 18th of 2016. What changed was one administration's interpretation of whether private prisons were politically acceptable. That is the trapdoor. The entire financial model, the per diem rates, the bed guarantees, the balanced operating cost structure, rests on a single assumption, that the government will continue to want the beds. Not that it will need them, that it will want them. Political preference is not the same as contractual obligation, and private prison operators, despite their bed guarantee clauses, cannot sue their way back to relevance when an administration decides to phase them out. The Yates memo of 2016 is the cleanest example, but it isn't the only one. In 2013, CCA lost 4 prison contracts in a single month, in Idaho, Texas, and Mississippi, after a combination of violence incidents, falsified staffing reports, and public pressure made those contracts politically untenable for state officials. In Idaho, the company had billed the state for 4,800 hours of unfilled guard posts. In Mississippi, the facility had experienced multiple riots, including a fatal stabbing. In each case, the formal trigger was a contract review. The actual trigger was political sustainability. Now let's run the numbers on 2 different years for our Model 1,000-bed facility. Good year, the facility runs at 95% occupancy under a federal immigration contract at $110 per person per day. Total per diem revenue comes to $38.1 million. Auxiliary services, healthcare billing, program fees add $3.6 million. Commissary and telecom revenue sharing adds $1.2 million. Total revenue, $42.9 million. Operating costs run $34 million. Staffing, healthcare, utilities, insurance, legal reserves. EBITDA is $8.9 million. After $9 million in annual debt service, net income is roughly negative $100,000. Barely above water, not a disaster. Bad year. The political environment shifts. The federal contract is not renewed. The operator scrambles and finds a state contract at $62 per person per day at 80% occupancy, below the bed guarantee threshold, meaning the state is paying for empty beds but at a reduced rate per the renegotiated terms. Per diem revenue falls to $18.1 million. Auxiliary service revenue drops proportionally to $2.1 million. Telecom and commissary revenue falls to $700,000 as population declines. Total revenue, $20.9 million. Operating costs don't fall much. Staff still needs to be there. The building still needs to be maintained. Insurance still costs the same. Costs compress to maybe $28 million with aggressive staffing cuts. EBITDA is negative $7.1 million. After debt service, net loss is $16.1 million. The difference between those 2 years is $16.2 million in net outcomes on the same asset, with the same beds, in the same location. That is not a business risk. That is a political risk wearing a business suit. And yet, and this is the part that confuses people who only look at the 2016 collapse, Sophisticated investors and major corporations keep buying into this space. CoreCivic and GEO Group did not disappear after 2016. They restructured, rebranded, and waited. When the Trump administration reversed the Yates memo in February 2017, private prison stocks recovered. When immigration enforcement expanded in 2019, new contracts followed. When the Biden administration issued an executive order limiting DOJ private prison contracts in January 2021, it excluded immigration detention, which had become the dominant revenue driver for both companies. By 2025, GEO Group reported $2.6 billion in total revenue, a record. CoreCivic reported $2.2 billion. GEO Group reactivated 4 idle facilities totaling 6,600 beds for ICE alone, expecting those 4 facilities to generate more than $240 million per year. CoreCivic signed a 5-year contract to reopen the 2,400-bed Family Detention Center in Dilley, Texas, a facility that had been closed by the Biden administration, with expected annual revenue of $180 million. The day after the 2024 election, GEO Group's stock price rose 41%. CoreCivic's rose 29%. In a single trading session. Why do sophisticated investors keep participating in a business this politically volatile? Because the volatility itself has a pattern. Private prison stocks are not priced on fundamentals, they're priced on political signal. An election outcome, an executive order, a new enforcement priority, these are the actual drivers of valuation. For investors with the right political read and the patience to hold through the down cycle, this is not a flaw. It's the model. There's also a tax element that long shielded these companies from federal income tax entirely. For most of their history, CoreCivic and GEO Group operated as REITs, real estate investment trusts, a classification that required distributing at least 90% of taxable income to shareholders as dividends and exempted the corporate entity from federal income tax. Prison buildings were treated as income-generating real estate. Both companies converted back to standard C corporations effective January 2021, partly due to pressure from institutional investors, partly because the REIT structure had become difficult to defend publicly. But for years, that structure allowed investors to receive substantial tax-advantaged dividends from an asset that paid effectively zero corporate income tax. And then there's the moat. The 3 companies that dominate private prisons, CoreCivic, GEO Group, and Management and Training Corporation, collectively controlled 96% of all private prison beds in the United States as of 2014. 5 states have laws that explicitly require demonstrable prior experience in prison management as a condition of bidding, which means that, by law, new competitors cannot enter. In Arizona, Louisiana, Oklahoma, and Tennessee, the incumbent protection provisions are explicit. The barrier to entry isn't capital, it's regulation. Regulation that the incumbents lobbied to create. Here's what you should understand about owning a prison. The business model, stripped to its essence, does not primarily depend on crime rates, on recidivism, on public safety, or on the actual efficiency of incarceration. It depends on 2 things: the government's willingness to keep filling beds, and the company's ability to keep costs low enough that the per diem covers them. Those 2 things are in constant tension, because the cheapest way to fill beds is to lobby for longer sentences, stricter enforcement, and expanded detention categories, activities that CoreCivic and GEO Group have spent collectively tens of millions of dollars pursuing. CoreCivic alone spent $10.6 million on immigration-related lobbying between 2008 and 2014. And the cheapest way to contain costs is to understaff, underserve, and cut corners on healthcare and programming, which creates conditions that eventually produce riots, lawsuits, investigative reports, and contract terminations. The business has an internal contradiction baked into it. It succeeds in the short term by doing things that tend to destroy it in the medium term. CCA's own 2014 annual report disclosed this plainly. In the risk factors section, the demand for our facilities and services could be adversely affected by the relaxation of enforcement efforts, leniency in conviction or parole standards and sentencing practices, or through the decriminalization of certain offenses. A company disclosing to its investors that falling crime rates are a financial risk is not describing a business. It is describing a dependency. The real estate analogy breaks down entirely when you read that sentence. No apartment complex files a risk disclosure, warning investors that rising incomes could threaten occupancy. But a private prison has to warn its shareholders that less crime means less money. The tenant isn't someone who chose to be there. The occupancy rate isn't driven by market demand. It's driven by policy decisions made by people who are not the operator, not the investor, and not the inmate. What private prison companies actually own is not a building. It's a position in a political supply chain. They own infrastructure that is useless without a government willing to fill it, revenue that disappears without a contract, and a workforce that turns over constantly because the job is grueling and the pay is deliberately kept low. The building is real, the business is conditional, and the condition, as a 40% single-day stock collapse in August 2016 and a 41% single-day stock surge in November 2024, both make perfectly clear, is not occupancy. It is not crime. It is not efficiency. The condition is, who won the election?